What if everything you think you know about money is a carefully constructed illusion? We're told to save. Money isn't just printed. It's conjured from debt in a process so counterintuitive, it defies basic logic. Forget what you learned in school. This is the real story of how your financial reality is manufactured, controlled, and constantly manipulated behind closed doors. Imagine a world where money isn't just paper in your wallet, but a living, breathing force flowing through invisible channels. What if I told you that every time you swipe your card or transfer funds, you're participating in a global dance of capital that's been choreographed over centuries? We're about to pull back the curtain on the financial system's inner workings, not with dry textbook explanations, but through the stories of ordinary people whose lives are quietly shaped by these hidden currents. You'll meet Sarah, who thought her mortgage was just between her and the bank until she discovered how it gets bundled with thousands of others and sold across the world. You'll follow Miguel, whose small business loan traveled through 3 different financial institutions before reaching his hands. This journey will reveal why your savings account pays barely any interest while credit card companies charge 20% by the end of our time together. That simple piece of paper connects you to a vast, pulsating network where decisions made in distant trading floors ripple directly into your grocery budget and retirement plans. Picture a world where money was simple. A farmer trades eggs for a neighbor's wheat. Value was tangible, direct, and understood by everyone involved. But what happens when a society grows beyond the village square? How do you build an economy that spans continents? The answer was a revolutionary invention, one that would eventually become the bedrock of modern civilization: debt. Centuries ago, goldsmiths noticed something peculiar. People would deposit their gold for safekeeping and rarely withdrew it all at once. A ledger entry, a simple promise to pay, began to circulate as a form of payment itself. This was the quiet birth of paper money, not as an object of value, but as a token of trust. A single slip of paper could now represent a claim on real gold sitting in a vault. The genie was out of the bottle. Yet this system had a fundamental limit. An economy could only grow as fast as miners could dig new gold from the earth. Progress was chained to the luck of a geological lottery. Then came the pivotal moment of departure. In 1971, President Nixon severed the US dollar's last link to gold. Money was no longer a promise of metal, it was a promise of a promise. The entire global financial architecture floated free, untethered from any physical anchor, sailing into the uncharted waters of pure faith. This faith is the true capital of our age. We collectively believe a piece of colored paper or a digital entry in a bank's computer has worth, and so it does. This belief powers everything. It builds cities, launches technologies, and funds wars. But this system, for all its power, is built on a fundamental paradox. It requires perpetual growth to avoid collapse, a relentless expansion of credit and consumption just to remain stable. The machine must be fed constantly. Consider the sheer scale of what this belief creates. The total value of all the goods and services produced globally in a year is around $100 trillion. Yet the value of all financial assets, stocks, bonds, derivatives, soars into the quadrillions. The world of finance has become an ocean, vast and deep, while the real economy of things we make and use is merely a boat upon its surface. This disconnect is the source of immense opportunity and profound fragility. We now live inside this machine. Its hum is the background noise of our lives. Its health dictates our prosperity, its failures our despair. But very few of us are taught how the engine room works. We are passengers on a ship. To understand this is to understand the invisible force that shapes your world. The fundamental conflict at the heart of our financial system begins with a simple but startling reality. Most money isn't printed by governments at all. How can this be possible in a world where we're taught that central banks control the money supply? The uncomfortable truth is that commercial banks create the vast majority of our money, roughly 97% of it, every time they issue loans. This isn't some conspiracy theory. It's the mechanics of fractional reserve banking operating exactly as designed, though rarely discussed in mainstream economics education. Consider what happens when you walk into a bank for a mortgage. Does the bank lend you money that other depositors have saved? That's the common misconception. In reality, the bank creates new money electronically by simply adding digits to your account balance. They're not transferring existing funds. They're generating purchasing power out of thin air, backed only by your promise to repay with interest. This process transforms what should be a neutral medium of exchange into something fundamentally different. Debt-based money that must constantly expand to avoid collapse. What happens when this debt-based system meets human psychology? We get the inevitable boom-bust cycles that have characterized modern economies for centuries. Banks have every incentive to lend aggressively during good times, flooding the economy with newly created money that drives asset prices higher. But when confidence wanes, the reverse occurs. Credit contracts, money effectively disappears from the system, and the house of cards trembles. The 2008 financial crisis wasn't an anomaly. It was the logical endpoint of a system built on this inherent instability. The tension becomes even more apparent when we examine who benefits from this arrangement. Every newly created dollar comes with interest attached, creating a mathematical imperative for perpetual growth that may not align with environmental or social realities. Does an economic system that requires constant expansion make sense on a finite planet? This structural conflict between financial demands and physical limits creates mounting pressure that manifests in everything from housing bubbles to climate change. Central banks attempt to manage these tensions through monetary policy, but they're fundamentally fighting against the system's design. When they lower interest rates to stimulate lending, they're essentially encouraging more private money creation, the very process that creates instability. When they raise rates to cool inflation, they risk triggering the credit contraction that causes recessions. It's a perpetual balancing act with no stable equilibrium, because the system itself contains contradictory objectives. Look at the housing market as a perfect example of this conflict in action. As banks create more mortgage debt, they simultaneously create the money that bids up property prices. Home buyers then need even larger loans to purchase the same assets, creating a self-reinforcing cycle that separates housing from its fundamental purpose as shelter and transforms it into a financial instrument. The result? Generations priced out of home ownership, while the financial sector profits from the very process that makes housing unaffordable. This brings us to the psychological dimension of the conflict. We're all embedded in a system where going into debt is often the only way to participate fully in the economy, whether for education, housing, or starting a business. Yet that same system penalizes savers through inflation and rewards leverage, creating constant tension between prudent financial behavior and the demands of modern life. Are you making rational choices, or simply responding to incentives built into a system that needs your debt to function? The most profound conflict may be between what the system promises and what it delivers. We're told that expanding credit creates prosperity, yet we see wealth inequality reaching historic levels. We're assured that central banks can manage the business cycle, yet financial crises appear to be growing more severe. The tension between the theory and reality of our monetary system suggests we're not dealing with temporary flaws, but fundamental structural problems that can't be solved with minor adjustments. Understanding this conflict is the first step toward imagining alternatives. Have you ever wondered why the stock market sometimes feels like it's operating on a completely different planet from the real economy? A company can announce layoffs and its stock price soars. Or a piece of terrible economic news comes out and the market rallies. It seems illogical, right? That's because we're often looking at the wrong layer of reality. We're focused on the fundamental news, the earnings, the GDP reports, while the market is responding to something else entirely, the plumbing of the financial system itself. Imagine the entire financial world as a massive, interconnected network of pipes, valves, and reservoirs. This isn't just about stocks and bonds, It's about the flow of money and credit between banks, hedge funds, corporations, and governments. The prices you see on your screen are often just the surface-level bubbles showing you where the pressure in this system is building or releasing. When there's a sudden violent market move that seems to defy the news, it's usually not about the news at all. It's a signal that something in the plumbing has either clogged up or a valve has been forced wide open, causing a tidal wave of liquidity to rush in or out of certain assets. What creates the pressure in these pipes? It's not just central bank printing presses. The primary engine is the creation of private credit. Every time a bank makes a loan, new money is created in the economy. This new money needs a home. It flows into assets, bidding up their prices. But this system is built on confidence and collateral. When confidence is high, the pipes are wide open and money flows freely. When confidence evaporates, the pipes seize up. Lenders demand more collateral for the same loans, or they stop lending altogether. This is the infamous credit crunch, and it's why the market can sometimes nosedive even when the economic data still looks okay on the surface. The market isn't pricing today's reality, it's anticipating tomorrow's liquidity conditions. Consider the repo market, a multi-trillion-dollar daily lending market most people never see. It's the ultimate plumbing system. When it freezes, as it did briefly in 2019 and then catastrophically in March 2020, the entire financial engine sputters. The Federal Reserve had to step in with trillions of dollars to act as the ultimate plumber, unclogging the pipes. Those market moves weren't about corporate profits. They were about the sheer survival of the system that allows trading to happen at all. Understanding this distinction is the difference between being a casual observer and someone who can read the deeper currents. Strange but true. How do you, as an individual investor, navigate this? You have to learn to watch the gauges on the plumbing, not just the weather outside. Pay attention to things like the Fed's balance sheet, the Treasury General account, and credit spreads. When the Fed is adding liquidity, it's like turning on a fire hose into the system, and that water has to go somewhere, often into risk assets. When they're draining liquidity, the tide is going out, and it becomes much harder for all boats to float higher. This perspective explains why the simple buy and hold strategy works until it doesn't. It works beautifully during long periods of expanding liquidity and breaks down during sudden contractions. The most profound insight is this. The market is not a voting machine on corporate health in the short term. It's a complex barometer of financial system liquidity and stress. Quick thought. A company can be fundamentally sound, but if its stock is used as collateral in a highly leveraged trade and the system experiences a margin call, that stock can be sold indiscriminately. Its price becomes disconnected from its value, not because the company changed, but because its role in the financial plumbing changed. Real talk. This is the uncomfortable truth that separates the amateurs from the professionals. The pros aren't just analyzing income statements, they're monitoring the flow of funds, the leverage in the system, and the health of the credit markets. They know that in a crisis. It's not personal, it's hydraulic. Imagine you're a young couple, Sarah and Mark, saving for a down payment on your first home. You've diligently set aside $50. The central bank's monetary policy, keeping interest rates low to stimulate borrowing, means your cash earns almost nothing. This isn't just bad luck, it's a direct consequence of how the financial system prioritizes liquidity and credit expansion over the saver's real returns. What can you do? Instead of leaving that money idle, you could ladder it into short-term treasury bills or inflation-protected securities. These instruments are influenced by the very same monetary system, but are designed to preserve value when traditional savings falter. Consider the small business owner, Maria, who runs a local bakery. When the Federal Reserve engages in quantitative easing, it floods banks with reserves, theoretically making loans cheaper and more accessible. Yet Maria finds her loan application rejected because the new liquidity often flows first to large corporations and financial institutions, not Main Street. This divergence highlights a critical flaw in transmission mechanisms, the pathways through which central bank policies reach the real economy. Her experience underscores why understanding the system's plumbing matters. It reveals who truly benefits from monetary interventions and who gets left behind. Picture this. Shift perspective to an institutional investor managing a pension fund. With bond yields suppressed by prolonged low-rate policies, the fund faces a shortfall in meeting future obligations. To bridge the gap, the manager increases allocation to riskier assets like equities and corporate debt. This reach for yield behavior isn't mere speculation. It's a rational response to a financial environment shaped by central bank actions. But it also concentrates risk across the system, making markets more fragile. One pension fund's adaptation, multiplied across thousands, can amplify systemic vulnerabilities. What happens when these individual stories intersect? Look no further than the housing boom and bust cycles. Easy credit conditions, driven by expansionary monetary policy, fuel mortgage lending and inflate asset prices. Home buyers, encouraged by low rates, take on larger debts. Builders expand supply. But when rates rise or credit tightens, the reversal is brutal. Households with variable rate mortgages face payment shocks, and over-leveraged developers confront bankruptcy. These aren't isolated events. They are emergent phenomena of interconnected financial behaviors. Even your retirement portfolio isn't immune. If you've ever wondered why your 401k swings wildly with Fed announcements, it's because asset prices are increasingly tied to liquidity conditions rather than pure fundamentals. When the central bank injects liquidity, risk assets often rally, sometimes disconnecting from underlying economic health. Recognizing this link helps you contextualize market volatility not as random noise, but as a reaction to systemic liquidity flows. Each case study illustrates a core principle. The financial system's architecture shapes every economic decision you make. Whether you're saving for a home, seeking a business loan, or investing for retirement, you're navigating a landscape designed by policymakers and institutional mechanics. Ignorance isn't just costly, it's risky. But with this knowledge, the system's rules are fixed, but your strategy shouldn't be. Picture this. Here we are at the end of this little tour through the grand, glittering casino we call the financial system. You now know the secret. It's a shared hallucination, but one with very real consequences for your wallet and your future. Isn't it liberating, in a strange way? The entire global economy, with its trillions in digital entries and frantic traders, ultimately rests on something as fragile and human as a feeling. It's like discovering the monster under your bed is just a pile of coats, but a pile of coats that can still trip you up if you're not careful. You are no longer just a passenger on this ride. You have a map. You understand the language of the casino floor. You can see the levers and pulleys behind the velvet curtain. This knowledge doesn't just make you smarter, it makes you calmer. The next time the market throws a tantrum or a new, sure thing is hyped on every screen, you won't feel that primal panic. You'll see the narrative at play. You'll recognize the game. Remember, the goal isn't to beat the system in some dramatic movie-style showdown. The real victory is in quietly, consistently, making it work for you. It's about building a life that isn't hostage to the daily drama of numbers on a screen. The most powerful financial move you can make is to stop being a character in someone else's story and start writing your own. Go be the calm. Your future self will thank you for it.